Welcome back to Candlestick Signals for today's market. September 5th, 2025. Brace yourselves for a roller coaster ride as we dive into the candlestick signals that are shaping the financial landscape. Today's market is a battlefield of bearish formations and mixed sector momentum, with some surprising twists you won't want to miss. Let's decode the market's message together. Our analysis begins with a snapshot of the Nifty 50, which experienced a day of intense profit-taking. Despite nearly losing 250 points in early trading, the index managed to close moderately higher. The Bank Nifty, a crucial barometer of financial sector health, showed persistent signs of weakness. Bearish candles dominated its chart, with the index struggling to break above crucial exponential moving average EMA levels. This bearish sentiment was particularly evident during the morning session, with the Bank Nifty hitting its lowest point of 35,200 at 10:45 a.m. Volatility spiked across the board, reflecting the market's uncertainty. The India VIX, often referred to as the fear gauge, surged by 8.5% to close at 18.2. This increase in volatility underscores the cautious sentiment prevailing among investors. Despite an undercurrent of attempted bullish momentum in certain pockets of the market, now, let's delve into the candlestick structures that dominated today's trading session. The most prominent patterns observed were bearish engulfing, doji, and bearish belt hold or meeting line patterns. These formations were particularly visible as markets approached critical support and resistance levels. A textbook example of a bearish engulfing pattern emerged in PROVETRY, a high-volume stock at the price point of $36.13. This pattern, characterized by a small bullish candle followed by a larger bearish one that completely engulfs it, signals a potential trend reversal and often precedes significant downward moves. Traders watching PROVETRY should be cautious, as this pattern suggests strong selling pressure overtaking buying interest. Doji candlesticks, those small-bodied candles with long wicks, made frequent appearances today, notably at the $35.71 level in PROVETRY. These doji formations indicate periods of indecision in the market, where neither bulls nor bears have a clear upper hand. Such patterns often precede significant price movements and warrant close attention from traders looking for potential breakout opportunities. From a technical perspective, bearish momentum received validation from key indicators. The moving average convergence-divergence MACD showed a bearish crossover in several major stocks, a signal that often precedes extended downtrends. Meanwhile, the Relative Strength Index or SI tested oversold territory near 30 across a broad range of equities. With only weak rebound attempts detected, the Nifty's technical backdrop presented a mixed picture, while the index managed to hold above the Bollinger Band midline and the 100-day EMA. The prevalence of large-bodied bearish candlesticks kept the overall tone subdued. This conflicting technical scenario suggests that traders should remain vigilant for potential false breakouts or breakdowns in the coming sessions. Sector-wise, financials and industrials, particularly in the large-cap space, displayed the highest frequency of bearish engulfing and meeting line patterns. This bearish sentiment was fueled by aggressive profit booking and deteriorating technical indicators. The financial sector saw a market capitalization change of -2.3%, translating to a loss of $18 billion. Major banks like HDFC Bank and HIE Bank were at the forefront of this bearish trend, with their stocks forming clear bearish engulfing patterns at 1:45 p.m. and 2:15 p.m., respectively. In the industrial sector, heavyweights such as Larsen & Toubro and Siemens India contributed to the bearish narrative. The sector experienced a 1.8% decline, wiping out $12 billion in market value. Bearish belt hold patterns were particularly evident in these stocks during the last hour of trading. Between 3 p.m. and 3:30 p.m., signaling potential further downside, consumer and IT sectors, primarily in the mid and small cap segments, presented a more mixed picture. Doji and harami patterns were frequently observed, indicating indecision and potential inflection points. These sectors showed less directional conviction compared to their large-cap counterparts. The consumer sector managed a modest gain of 0.5%, adding $3 billion to its market cap, while the IT sector remained relatively flat, with a marginal 0.2% increase. The energy sector provided a glimmer of hope amidst the bearish landscape. Isolated bullish reversal signals appeared in select commodity stocks, though the overall sentiment remained cautionary. Notable energy firms like Reliance Industries and ONGC formed bullish engulfing patterns at 11:30 a.m. and 1 p.m., respectively, hinting at potential upside. The sector closed with a 1.2% gain, adding $7 billion to its market capitalization. Market sentiment leaned decidedly bearish due to the preponderance of large bearish candlesticks and subdued bullish responses to oversold signals. While there was some sector-specific accumulation, particularly in energy stocks, the broader outlook remained consolidation-biased, with a risk of extended declines if support zones are breached. A summary of today's candlestick patterns across sectors reveals the following. In the financial sector, bearish engulfing patterns dominated, with 16 occurrences compared to just 4 bullish formations. Major index components and large-cap banks were the primary contributors to this bearish trend. Industrials saw 11 bearish belt hold or meeting line patterns, overshadowing the 3 bullish signals observed. Key index components in this sector were particularly affected by these bearish formations. The consumer sector presented a more balanced picture, with 9 bullish and 6 bearish patterns, primarily doji and harami formations in mid-cap cyclicals. IT stocks displayed 7 doji patterns, indicating indecision, alongside 5 bearish signals. Select tech leaders were at the forefront of this mixed sentiment. Energy stood out with 5 bullish engulfing patterns, albeit few in number compared to 2 bearish formations. Noted energy firms led this cautiously optimistic trend. As we conclude our analysis for September 5, 2025, it's clear that the market is dominated by bearish candlestick patterns, especially within high capitalization industries like financials and industrials. The prevalence of bearish engulfing and meeting line signals across these sectors suggests potential further downside in the near term. Mid-cap consumer and tech sectors exhibited notable indecision, manifesting as doji and harami patterns that warn of potential reversals or trend pauses. Traders should pay close attention to these formations, as they often precede significant price movements. The energy sector's isolated bullish signals provide a counterpoint to the overall bearish narrative, but caution is still advised given the broader market context. Traders should be wary of potential false rallies and remain alert to the risk of continued corrective movement, especially if pivotal support levels fail to hold. In this volatile environment, it's crucial to monitor candlestick patterns near key technical levels for confirmation of trend continuations or reversals. As always, risk management should be at the forefront of any trading strategy in these uncertain market conditions. Stay tuned for our next market analysis, where we'll continue to decipher the market's candlestick signals and provide you with insights. Until then, trade wisely and stay informed. Thank you so much for watching. I hoped this video helped you out. We will see you back here tomorrow. Before you go, please leave a comment, smash that like button, and subscribe and click the bell to be notified when new content is available. The information presented in this report is intended solely for entertainment and informational purposes and does not constitute financial, investment, or trading advice. All opinions, analysis, and statements expressed herein are personal views and are not recommendations to buy, sell, or hold any securities or assets. Market data and any related commentary are provided as is, and may not be accurate, complete, or up to date. Neither the author nor the publisher assumes any liability for financial losses, damages, or other consequences resulting from actions taken based on the information contained in this content. Please consult with a qualified financial advisor or conduct your own independent research before making any investment decisions. Investing in financial markets involves risk, including the potential loss of principal. This content is purely for entertainment purposes and should not be relied upon for any financial decisions.